Hey, and welcome back to Kelly's Take Two Pre-Licensing Review. So great to see ya. Today we're going to be going over Unit 3, which is all about encumbrances on real property. We're going to be discussing the difference between a general lien and a specific lien, as well as spending a lot of time talking about easements, the various types of easements, and how you create an easement. There are other encumbrances that are also listed in Unit 3. There are 5 in total, but we're really going to focus on the 2 most important with the details that we need to cover. So that again will be liens and easements is what we're going to be going over today. All right, so as you guys recall from the other day, let's talk about liens in terms of being a specific lien that attaches to a property or a general lien that attaches to the individual. The word lien is a very old, I believe it's an old French word, and it's always involving money. So if you want to put that down somewhere, that a lien always involves money, that would make sense. All right, so let's start with specific liens. Specific liens, I know y'all are saying, oh, I can't believe Kelly wasn't an art major. Almost was. Okay, maybe I almost was, but stuck with education. But here you go. So this is my little craft project. This is a house, and at the top it should say specific lien, but of course we're on the computer and the video, so it's backwards naturally, don't you know? Okay, so let's talk about some items that would be considered a specific lien. Let me grab my sticky notes here and we'll show you what that's going to look like. All right. Well, one of the most important specific liens that will attach to your house, and when it attaches to your house, we would say that the lien is appurtenant to the property. It sticks to the house. Very good. Sticks to the property, not the person. So property taxes for the year will always stick to the house, and property taxes are what's called a superior lien, which means this property tax payment will always take priority over any other liens that are filed that may need to be paid off. All right, let's talk about how about a home loan. The word or term for a home loan in some states is a mortgage, but in our state, it's considered to be a deed of trust. We use a third-party lending instrument. You'll learn about that in Unit 14. I know. But other states use a two-party instrument called a mortgage. A home equity line of credit, that's one way you can access the equity in your home without selling it. That's going to be a specific lien that attaches to your property. A mechanics lien, we're going to talk about that in a minute as well. A mechanics lien is going to stick to your property. Very good. And a UCC1. So if you have your windows financed through a window company or your gutters financed through a gutter company or whatnot, that company is going to file a UCC1. It will be a lien against your property. Essentially, you're pledging your property as collateral for the debt. If you don't pay one of these off in the proper amount of time, that group or that business entity or that governmental body could potentially foreclose on your property. We might call that taking action, meaning taking court action, meaning starting the foreclosure procedure or process. All right, so what do we know? Specific liens stick to the property, not the person. That means that if I want to go ahead someday and transfer this property to another individual, they don't want my property with all this clutter and such, all this debt attached to it. They don't want that. They're going to expect that I, the homeowner, clear these debts from this property prior to the transfer. So my person who buys my house is going to expect that we decide that we go ahead and prorate the property tax bill for the year, that I, the current owner, pay off any kind of a mechanics lien out of the proceeds of my home, that I pay off any UCC1 document from me financing gutters or some such thing. I'm going to pay off my home equity line of credit. And I'm going to, of course, pay off my home loan. And once I do all of that, once I clear all of the liens off my property, it's going to be ready to transfer to the next homeowner. Fantastic. All right, now let's switch gears and talk about a general lien. General liens stick to the person and all of the person's assets. So a general lien could involve real property, but it will involve more than that typically. So let's start with an injury lawsuit. So let's say that I'm involved in a car accident of some sort and someone is suing me to take care of their medical bills. So I am involved in an injury lawsuit. So that debt, let's say it's $500,000. Oh, I hope not, but let's say it is. That judgment sticks to myself and all of my assets. Like what assets, Kelly? Well, it could be that I have to sell my boat. I might have to sell my horse. I might have to sell my house, some such thing, in order to get the money together to take care or satisfy that injury lawsuit. Another general lien will be anything involving your income taxes. If you forget to pay your income taxes, the IRS, that's going to be a general lien on a person and all of their assets. If you become delayed in paying your child support, that is going to be a general lien that sticks to the person and all of their assets. And then any kind of court settlement, if you're involved in some kind of litigation and there's going to be a settlement of some sort, in order to satisfy that settlement, you have to liquidate your assets. So the settlement is going to stick to you and all of your assets until you pay that court settlement off. Very good. So that is the difference between a general lien and a specific lien. Fantastic. All right. Let's talk about a couple of the specific liens. Specifically, a mechanics lien. Okay. A mechanics lien is one that benefits a contractor or a general contractor in the instance where the homeowner might be, I don't know what, could be disgruntled, could be unhappy and refuses to pay the contractor or the subcontractor. Well, the recourse that the contractor has is to file something called a mechanics lien. That lien is going to go against the property. So it's going to attach to the property, not the homeowner, but the property itself until that is satisfied or the contractor removes that lien. So the contractor, here's the interesting thing about mechanics lien. The contractor has a total of 180 days to take action. And when we say take action, go Teddy Roosevelt. That used to be his saying, get action. Teddy Roosevelt, former president. But I digress. In a mechanics lien, you have 180 days to take action, which means to actually start the foreclosure process. You don't have to start it, but you can. And you have a maximum of 180 days to do so. Now, here's the deal. The mechanics lien has to be filed at the courthouse, county courthouse, within 120 days of completing the job. Now, your book will state that in some funny language or whatnot, but essentially it boils down to when the work is done, the clock starts ticking. So you've got 180 days to file the complaint or the mechanics lien at the courthouse. And then you have 180 days total to start the foreclosure process. Now, what's interesting is when we talk about the order in which liens get paid off, that's called priority of liens. A mechanics lien is able to jump back in line as if it were filed on the first day they started work, the contractor started work. So it will look like that when it comes to paying off liens in a foreclosure. So again, if the property, if the work is done, let's say February 1st of 2021, but the job started in August 2020, it will appear as if when it comes to lien priority, that mechanics lien will get paid off as of August 2020. So it gets to jump in line in front of some other liens when it comes to lien priority. Lien priority is a big deal. What it means is if we have a forced sale, a tax foreclosure sale of some such thing, we're going to pay off debts associated with the property. We're going to pay those debts off in order of recordation. So some liens will take priority over others. Your property tax bill, your property tax lien will always get paid first, along with if there happens to be a special assessment levied by your local government, that will be paid off right at the same time as your property tax lien. Your local government's not playing with their money. Why? Because that's how they set their budget annually. They set their budget typically based on a fiscal year. So right now we're going through that process. So your local government is going to vote on their property tax rate for the coming year. They're going to set their budget. It'll be announced around July 1 annually, along with their budget proposal. This is all public knowledge, public record. And then your bill will come out sometime in September. Very good. So that property tax lien is really important for the functionality of your local government. Paying that tax bill is a big deal. So they're not playing with that. So if you sell your property, your tax bill will need to be prorated as reflected with the day of closing. So if you are going to sell your property, let's say in the spring of a certain year, then the property tax proration will be based on last year's rate. They'll generate a bill based on last year's rate and prorated as such. Very good. Your property taxes and special assessments are considered superior liens because they get paid first. Everything else gets paid in order of recordation. Very good. I think that's all I want to tell you about that. Let's talk about some North Carolina specific rules when it comes to property taxation. Property taxation in North Carolina is governed by something called the Machinery Act. So the state sets forth the guidelines and the rules regarding property taxation, and then they enable your local county and your local city, your local town, and so forth, to levy the taxes and collect the taxes and all of that sort of thing. In North Carolina, homeowners, property owners are taxed on 100% of value, of tax assessed value. Every 8 years, an assessor is hired. Well, you've got your county assessor, and every 8 years, your county assessor is going to go out and appraise all of the properties located in the county boundary. They use their own kind of mathematical formulas for that. So it's similar to a regular home appraisal, but slightly different. That's going to be done every 8 years, and that's called the octennial plan. So octennial, think octopus with 8 tentacles. Octennial is every 8 years. Every 4th year, your local government has the right to do an adjustment or conduct an adjustment regarding assessed values. That just happened here in Buncombe County this past spring. And I know personally, my own property taxes went up about 18%. I've heard of some tax assessed values going up as much as 30%. So there is that. Now, other states, so we're taxed in North Carolina at 100% of value, of true market value, tax assessed value. Other states do it differently. So on the national exam, if you have a question regarding a tax bill, realize that other states might only tax at 80% of tax assessed value or 50% of tax assessed value. So be prepared for that. Also, some states will tax according to property valuation, not per $100 of value like we do here, but per $1,000 of value. That's called a mill rate. We don't use that here in North Carolina, but they do in other states. So just be aware of that language. And I'll show you in a minute how you solve those math problems in just a second. which just a second might be right now. Okay, let's look at that. All right, since we're talking about taxation, let me clean up my little area right here, and I will show you a very fast how to solve for a tax bill. All right, fantastic. Let me make sure that you can see my board. It looks like yes, you can, which is great. All right, so if you're making a note card, go ahead and grab a note card, and on the front, you're going to call it annual property tax bill. Okay, very good. Annual property tax bill. And normally the way you do this, you could use a mill rate. I'll show you that in just a second, in the odd chance that it could show up on the exam, but it might. So normally your property tax bill is calculated this way. So you're going to take your tax assessed value. Kelly, where can I find out my tax assessed value? You can reference your county's geographical information system called the GIS. So you type in the name of your county plus GIS, and you should get right to it, and it'll pop it up. All right, you take your tax assessed value, divide by 100, because we are taxed at a certain amount per $100 of value. Then you multiply that by your tax rate. Remember that if you live in a city, you're going to pay city and county, and that will equal your annual bill. All right, when does the bill come out? It is mailed in September, essentially, sometimes August. It is due by January 5th of the following year. It is late on January 6th, and you'll have to pay a little penalty. It's not bad. It's not that much. I don't know how I know that, but anyway, it's not that bad. Okay. That's how you figure out your bill. Now, if you live somewhere where they're going to do a mill rate, same thing, except you're going to divide by 1,000. So for a mill rate, if you live in a state that follows that plan, you're going to have your tax assessed value divided by 1,000, because in those states, they're billed or taxed per $1,000 of value instead of per $100 of value. And you're going to multiply by whatever the mill rate is. And that will equal your bill. Do you want me to plug some numbers in? I bet you do. I bet you would love it if I would plug some numbers in. All right, let's do one. So let's say that, for example, for this normal one, the tax assessed value is $225,000, like it is for my neighbor's property right across the street, even though the house is falling in. All right, we're going to divide by 100. Why? Because we are taxed per $100 of value. And the tax rate, this house is in the city, so let's say that the city tax rate is 41 cents per $100 of value, and the county is 48 cents per 100 of value. So what do we have to do? Add that up. Nice. Okay. And let's see, that's going to equal our bill. All right, let's go. Grab your very inexpensive calculator. That's how you know you've got the right one that PSI, the testing center, will permit. If it's inexpensive, if it's cheap, if you got it at the ding dang dollar store, you're in good shape. Can't use anything fancy, including your iPhone. That's a no-go. All right, so 225,000 divided by 100, multiply by 0.89. Nice. Okay. Very good. So this person's tax bill is about $2,000, essentially, and some change, 50 cents. Okay. Nice. Let's go down here and do one regarding a mill rate. So let's do 310,000 divided by 1,000, because they are taxed a certain amount per $1,000 of value. And let's do a mill rate of 15 mills and see what their bill is going to be. 310,000 divided by 1,000. 1, 2, 3. Multiply by 15. That's the mill rate. All right. And they are going to be paying, their bill is going to be $4,650. Very good. All right. Nice, y'all. So that's your little math for that part of Unit 3. Unit 3 is all about encumbrances. An encumbrance is anything that's going to affect the transfer of title, which means the transfer of ownership from one parcel of property to another. And certainly your property tax bill would fall under that category. We've got to take care of that property tax bill by law upon the transfer of title. Okay. What else can affect? What other kind of encumbrance might affect the transfer of title? Well, we talked about liens, and we eased into property taxes because property taxes are a lien. Let's talk about the other one that comes up a lot, and let's discuss easements. Easements. A lot of us have some experience with easements. Let me clear my drawing and stop that share. Fantastic. And we're back. Okay. A lot of us are accustomed to easements. Why? Because we're sharing a driveway with somebody else to get to our property. That's usually the most common, frankly. So an easement, when it comes to easements, there are two types of easements. You've got an appurtenant easement, that's type number 1, and an easement in gross, that's type number 2. Now, when it comes to an appurtenant easement, the appurtenant easement involves 2 or more properties, and the easement benefits those properties. And the 2 properties involved, one is going to serve, think of this as like a serving tray. I know it's not, but just pretend for a minute, use your imagination. So pretend this is a serving tray. So one parcel is going to serve the other. Normally, this parcel that's going to serve the other is going to help the homeowner reach their property. So this property serves this property. See, they're going in their car to get to their house. So they're going to drive over top of the property that is serving and head on over to their house. They can't get to their house unless this property benefited or served their purpose. So again, one property serves, one property benefits. We call this the servient tenement parcel, and we call the parcel over here that's benefiting the dominant. Dominant driving over the servient to get to their house back here, back behind my shoulder. Let's pretend that again. So here we are, the servient tenement. The one that benefits is trying to get to its house behind my shoulder. Okay. So that parcel, both parcels, well, the dominant parcel benefits from this easement. Very good. An easement, appurtenant, like I said, is going to involve 2 or more parcels. And the players are, just to recap, the servient tenement and the dominant tenement. Now, conversely, we're talking about an easement in gross. When it comes to an easement in gross, only one entity or individual benefits, and it's not the property. When you have an easement in gross, you only have a servient parcel of property, one that serves. And then who benefits? It could be a business entity like a railroad company or a utility company or some such thing, and they're going to travel over your property and many other properties for many miles, right? In order to what? To have that railroad line or to have that utility track come through. So there's only one tenement, it's the servient, and the the entity that benefits is either that utility company, that railroad company, those sorts of things. The property does not benefit necessarily, but you could see why. I mean, you could have a big loud train coming through your backyard. Okay, we'll call that benefit. Anyway, let's move along. So how do you create an easement? You can create an easement by one of three ways. Number one, expressly. An easement may be created by express means. I'm going to go into each of these in just a second. So express is number one. Number two, by implication of law. And number three, by court order. And then I'll tell you some other names for that in just a minute. Let's go back to number one. You can create an easement expressly, meaning what? Express in real estate school means something different than what we normally think of. This took me years of teaching to finally get. People got confused over the word express. Express in real estate does not mean speed. It does not mean quickness. Express means expression. So to help you remember that, let's get kinesthetic with it. When I say express, think expression. Now, how can we express ourselves? We can express ourselves verbally or in writing. Either one is expression. So an easement could be created through expression, meaning something that people talk about, or it could be in writing. Which one do you think is better? You've got three answers. First two don't count. You're right. In writing is better. And by the way, in North Carolina, due to the Connor Act, easements must be in writing in order to offer protection against third-party ownership claims. Or just think of it as ownership claims. Someone popping up out of nowhere and saying, this is really my property. Okay, well, if you have your easement recorded or whatnot, then you've got a leg to stand on. You've got some protection against that type of a claim. All right, number two, an easement may be created by implication of law or out of necessity. So you can use those terms interchangeably, and easement by necessity, easement by implication. We normally say necessity, but it could show up either way. What number two means is that in North Carolina anyway, property is not allowed to be landlocked. So there has to be an easement in order to allow one property owner to get to their property over or via another person's land. Now, hopefully the owners can talk about it and make it work. But if they cannot, and they've got to go see Judge Judy or someone like Judge Judy, listen, whatever she says goes. So if she says, okay, you two are arguing about where to put an easement, I say the easement goes there. Boom, that's where the easement's going to go. It might go right through someone's apple orchard. So what? Life lesson. Work together to figure out where that easement's going to go. You really want to avoid going to court over this. But if you do, you will be seeking an easement by necessity. Number three, an easement by court order. You might also call this a prescriptive easement. So if an individual has been using a parcel as an easement for a period of 20 or more years in a certain manner, then they could prove that they have a right to that easement. Are they going to have to go to court? Yes. Are they going to have, the judge will hear testimony? Yes. And then make that final decision. I'm not saying those are easy to obtain, but that's the way you would go about it. So just to summarize, an easement may be created expressly, by implication of law or necessity, by court order, or by prescription.